Let's bring in Jeff Bierman, Chief Market Technician at TheoTrade. Welcome, Jeff.
Thank you very much, Kelly. Nice to be here.
No mincing words. Go at them. Go after those consumer staples. Tell people why they shouldn't be anywhere near them.
All right. Well, first off, let's establish why the consumer staples hit an all-time high in the fourth quarter. It was the old Wall Street sector rotation playbook, which meant, oh, if we're going into a recession, let's get out of the risk on stocks. Let's go into the risk off stocks. And so what managers did was they said, well, with all that uncertainty, let's go for the dividends. Let's go for the cash flows. They rotated into the Cokes, the Pepsis, the Procter & Gambles without a thought at all the valuation. So as they ran up and the year started to unfold, managers were piling out of tax loss harvesting losers into these stocks to window dress. Cut to the chase. Here comes January. No need to own these stocks anymore. Because why? Well, now investors are trying to signal that the recession is either never going to occur or the recession is already behind us because they're rolling back into growth stocks. And what happens? I saw the opportunity for stocks trading 2, 3, 4, 5 times their historical norms at all-time highs, took advantage and started building short trades around it, and it's paid off quite well. But I don't even think it's close to being over.
That's what I was going to ask, and I love the way that you put this, that either you're too late or it's not going to happen, and so you're in the wrong position. For those, Jeff, who are saying, okay, so I take your point, but what if in another 6 or 12 months, maybe I want to think about this? I mean, tell me how long you think, because you're shorting it, and how, for what period of time or for until what mile markers can you be in that trade?
I'm not going to describe it or pinpoint it by time. That's a fool's game. I pinpoint it by historical valuations. So, for instance, Coca-Cola, just demographically, grows at about, what, 3 to 5% annual. Earnings may grow at 8%. Stock trades at a 24 multiple. Let me put that in perspective, Kelly. You could buy Meta, Facebook. It would be half the cost and twice the upside. So what I'm telling you is you don't price these quote unquote safety stocks just because they're defensive. You price them according to their normal valuation growth going backwards in history. So Coke should trade around maybe 8 to 12, Procter & Gamble, the whole lot. And yet most of them trade at or above 20 times earnings. So I went after Coke, Campbell's Soup, General Mills. I just picked them all off. They've dropped about 20%. And my thinking is, well, if there's a new rotation, a lot of managers are going to say, well, if tech goes down, we'll go back to safety. That's a bad move because what's going to happen is you're rolling out of one bubble back into that same bubble again, thinking that it's a bargain because it's down 15 to 20%. So I call it bottom fishing, not bargain hunting.
Jeff, thank you very much. We appreciate your time. We'll continue the chat soon, I hope.